Hello, today we are going to be looking at how to use 4 important candlestick patterns in the Forex market. Candlesticks are formed by showing a candle body and wicks. A solid area between the open and close price is usually called the body of a candle, while the low and the high represent the wicks. At times some candle may be so solid that they don't have the low and they don't have the wicks, which means their open will be can be the low or high, and their close can be the low or the high. And then finally we can have a thin candle where we have very small body, a very less body, negligible body, where the price is volatile and ranges a lot within the day. In such case, when we have a thin candle, we have very small body and then more of shadows, more of wicks. The wicks are also known as the shadows. Candlesticks give us clues to price action. They tell us if there is going to be a possible trend continuation or a reversal. The first we are going to look at is the bullish engulfing bar, bullish engulfing candlestick. A bullish engulfing candle pattern is formed when price of a stock moves beyond both the high and low of the previous day range. It engulfs. Usually, this sort of pattern will tell a trader the price has moved down, it has found some support or buying volume, and then made a bullish move back up by breaking the previous day's high. Often, this type of candle can signal a sustained upward movement or trend change. This is an example of bullish engulfing pattern. You can see that this candle has actually engulfed, has overshadowed the previous day candle. The high is higher than the previous high, the low is lower than the previous low, and then the candle opened at this point and closed higher than the open. So this is a bullish engulfing pattern. It's a bullish candle which is also an engulfing candle. So this is a bullish engulfing candle. And then we say this we usually say that this candle, when it is formed during an uptrend, signals a continuation of the bullish trend. When it is formed during a downtrend, then signals the reversal of the bearish trend. An example below, look at this. This is a bullish candle which does not have wicks, it only has body, and it's a bullish candle which has engulfed the previous candle. So this is a bullish engulfing pattern, and you can see it is formed during let's call it bearish movement. So when this happens, then we expect a reversal to occur in the favor of the bulls, and you can see how the trend continues. This is a bearish engulfing pattern telling us that there will be a bullish reversal, which indeed happened. An aggressive trader will just buy the open of the next candle, while a conservative trader will place a buy stop like 10 pips above this candle, and you can see how the market went in favor of the buyers. Now the next one we're going to look at the bearish engulfing candlestick. It is the opposite of a bullish candle, bullish engulfing candle. A bearish engulfing candle pattern will move to test a level above the previous day, high. Then after finding selling volume or finding resistance, we move sharply downwards, breaking the previous day's low. This can be a precursor to a sharp sustained drop in price or trend change. Let's look at an example. Now this is a bearish candle. It opened high and closed lower. Now and then it engulfs the previous day candle. So this is a bearish candle engulfing the previous day candle. So that means we have a bearish engulfing candle pattern here. This is bearish engulfing pattern, and then you can see how that happens in our favor. Aggressive trader will sell immediately at the open of this candle, the next candle, while a conservative trader will sell few pips below the candle. So whenever we see this kind of pattern, we know we have bearish engulfing pattern. If it happens during a downtrend, then we have a continuation. If it happens during an uptrend, then we have a reversal. Now you can see an example here. This is an uptrend, and now we have a bearish engulfing pattern here. So that means we have a reversal. We should be expecting a reversal in the next sessions, and it did happen. See how it went down straight. So this is a good example of a bearish engulfing pattern and the effect it creates in the market. The third one is a hammer reversal candlestick. A hammer type pattern can form when support or resistance is sharply rejected by market participants. We are going to look at an example below where the price moved lower but found some support or buying volume. At this point, the bulls took control and closed the candle around its opening level. Let's take this example again. See, now when this happened, look at the candle here. The market, it was going down strongly, and eventually it found a support, a buying volume here. Buyers are coming in, and they gradually took the price up, and eventually close very close to its open, very near its open. So this is an hammer that is formed during a downtrend. You can now see the next day that we have a very strong bullish candle. Right, so this has already. So when this happens during a downtrend, what we are going to do is to place our buy order, buy stop above its high. That is in a downtrend. And then it happens during an uptrend, to play our sell order below its low. This is purely for reversal. It is not used for continuation. It is a reversal pattern. This is a reversal pattern, that a reversal pattern candlestick. Now look at an example here. We have an hammer at this point. The price has been going up successfully, but when we got here, we have this formation. Then we should pause and place. We protect. The buyer should protect their profits by using trailing stop, while they should also, the sellers can place their sell stop below this low, and then you can see how the market went. Again, at this point, we have hammer forming at the bottom of a bearish movement, hammer at the top of a bullish movement. This is signaling a top, while this signals a bottom. What the sellers will do here is to protect their profits by using trailing stop, and the buyers will put their buy stop above this high. And you can see how the market went in favor of the buyers. Now the last one is a doji candlestick. A doji candlestick is a name given to patterns which signify indecision in the price action of a stock or the currency pair. Usually these form at areas where the bulls and bears commence battle and are fighting each other for direction. Now we can look at the example below, how the commodity found new high. Look at it, the price has been going up, the bulls have been in control. Then we got here, we have a doji. Now the price opened here, and the found high, right? Then we find this high, went down. So we don't even know who is in charge now, because the price closed almost at the center of the candle. It opened and closed almost at the center of the candle. So we cannot call this a bullish bar, a bullish candle, or a bearish candle. So it's a candle that signifies indecision. So what we have to do is, when this happens, to place a sell stop below its low and a buy stop above its high. And then if we are in an uptrend and this happens, or this forms, we are supposed to protect our profits by using trailing stop or using any other method of profit protection. and then we expect that the trend will continue or reverse, and you can see how it happened that the trend actually reversed. If we had not used trailing stop, we would have lost all the profit that we had made initially, and then continue down. Then we go to this point again, we have a doji. Okay, the sellers are meant to, the wise sellers are meant to protect their profits by using trailing stop, and then you can place our buy order above the eye of this doji, and then you can see how it eventually went. So this is how to use doji in the forex trading. Now again, another example, doji candles at the top here and at the bottom here of the trend. Whenever they are formed, they show indecision at the current price. So when we place our sell stop below here when it is formed here during an uptrend, you place a buy stop above its eye when it's formed during a downtrend. All in all, these 4 candlestick patterns, when identified correctly, can be extremely useful for investors. Their movement is an excellent sentiment gauge, as long as you can understand what they are trying to tell you. Finding them as support or resistance can give you a heads up on direction change and offer an edge in your trading. I hope you enjoyed this video. I am so happy that you are watching my video, and I would like you to keep in touch with my channels. I will be bringing nice stuff your way. Please like this video, leave your comments and subscribe. Thanks a million.